Fellow traders, my name is Gonzalo, you can call me Gonzo, and we're going to talk about markets price movements today. We're going to talk about some impulsive and corrective moves and the volatile and non-volatile markets. So on impulsive and corrective moves, we need to be able to recognize the importance of the force behind them so that we can capitalize on their moves. Where on non-volatile and volatile markets, we need to see if we actually have capability of investing on those markets since they are too volatile or not. Starting with impulsive and corrective moves, the strength of the bulls and bears. Because it's always a battle between the bulls and bears to see who has more strength, to which I will talk about in the next few slides. Importance of identifying which side is winning. There are two teams that play in the market, the bears and the bulls. They make the market either rise or fall. The bulls create demand and consequently push the prices higher, whereas the bears create supply and pushing the prices down. These pushes and pull create movements called impulsive and corrective moves. We can use those moves to our advantage to identify which side of the market is in control and trade accordingly. But before that, let's talk about the impulsive and corrective moves and what they are. The corrective move. When there's a balance in the market between the bulls and bears, a corrective move is created where both sides are in agreement with the price stipulated, and this creates a sideways move. As you can see, we got touch there, touch on the bottom, touch on the top, touch on the bottom, touch on the top, and then it broke. So this is a corrective move. A corrective move is when the price is stuck in between two levels and it is moving sideways. When it's moving sideways, that's a corrective move. An impulsive move. In impulsive moves, there is an imbalance between bulls and bears, which cause the prices to move rapidly. Now having one of the teams present, ideally, these moves should be caught and capitalized in order to grow our portfolios, because we need to be able to recognize the corrective moves. If from the corrective moves, there's always a break of those corrective moves, because it will end up one side of the team to come out and the other side to end up winning, therefore moving the markets to one side or the other. As you can see on this image, we can say that it came out from a corrective move and then it broke and there was an impulsive, a bit of correction, and then another impulsive move. This is the difference between correctives and impulsive moves. With them in mind, in order to take advantage of these moves, we need to be aware of what they mean and how to utilize them. Only after that we can start to capitalize on them. Let me show you some examples. Now we have here a good example. You have a corrective move. We have an impulsive move to the upside. See if I can do it white. Then after this impulsive move, we have a correction. And then after the correction, we got another impulsive move. And now, this is where the market gets a little bit volatile. We got another impulsive move to the downside. But now, we can identify that we are on a corrective move. Not only this way, but this way as well. But because we got a counter-impulsive move to the downside and we're stuck on this correction, we now got an impulsive move to the downside. And after the downside, we got counter-impulsive to the upside, to which I will speak about the volatile and non-volatile markets. This is a very volatile market because we not only have impulsive and counter-impulsive moves, we have corrective moves, not a impulsive move, but counter-impulsive move, not respecting neither levels of support and resistance, nor dynamic support and resistance levels, which are these lines to create the corrective moves. Either way, we got another impulsive move. Do this one. Impulsive move down, impulsive move up, impulsive move down again. And then we have a long sort of correction after this impulsive move down, as you can see. So this means that the bears are in control. Then we got the big correction on the left that lasted just 21 days. And then when it broke over here, we got this massive impulsive move. This is just to show you the difference between corrective and impulsive moves. We're not actually trying to trade them, but you can get the idea of what I mean by impulsive and corrective moves. Corrective move. The bears were in control, and now after the corrective move, the buyers are in control. We got some sort of corrective move to the downside. It kind of did a false breakout, and then it came back up. This time respected this level of support, and they came back up. Impulsive move, more or less to there, and now we are in a corrective move. And supposedly we should be carry on going up. Now let's talk about volatile and non-volatile markets. A volatile market is a market that moves up and down mostly impulsively without really respecting its areas or levels of support and resistance, causing it to be very difficult to predict and hard to capitalize on them. Where non-volatile markets usually respect the levels and areas of support and resistance. However, the amount of price movement is minimal, making it difficult to make a great amount of capital or a great amount of profits. So this means that, in a volatile market, the market is moving too quick up and down. In non-volatile markets, they're respecting levels and they're moving more sideways. In my perspective, I think there's not one market that is completely volatile or completely non-volatile. They're always in between that spectrum. It's just volatile and non-volatile is just for us to identify which markets are easier or not to forecast and make our analysis so that we can capitalize on their impulsive moves. Now let's see some of volatile and non-volatile markets. For example, Euro USD. I think Euro USD is fairly non-volatile, but it has its moments. As you can see at this point of this big corrective move, it was respecting, so it's not much of volatile. Has some volatility, but it's not massive, and therefore we kind of can capitalize on their price movements. As you can see, it's respecting the levels of support, broke out, resistance, broke out, this was support, and now transforming to resistance, broke out, resistance, broke out, resistance, there's a level of support, broke out, touched as support, bounced, broke out, touch resistance, almost touching it again, broke out again, came back up, resistance, it broke out a little bit, so it false break, came back down. So this is just how to identify volatiles and non-volatiles. It's just to understand that Volatility is when the price is moving too quickly, irrationally, not respecting levels, and non-volatile is when it's respecting the levels most of the time, not making much of movements in between those levels. With that said, with practice and skills, we are able to capitalize on the market movements, which it takes a little bit of time to recognize what each bit it's doing, and with that, step by step, we can start improving ourselves and capitalize on the market movements. This is it for this episode. Thank you for watching. Hope you enjoyed. Please leave a likes and subscribe. Comment down below for any questions or thoughts about the video or content of this video. It will be much appreciated. So practice, take notes, ask questions, and keep growing. Thank you very much for watching. See you next time.